is Money Talks. I'm Greg Vogel, Portfolio Manager here at GKV Capital Management. Rules. There's so many rules. Of course, there's good reason for many of them. Most guidelines make decision-making a little safer, particularly in a complex world. To keep people from running into each other in the intersection, we have stop signs and traffic lights. Too many rule breakers and the world gets pretty dangerous very quickly. I probably shouldn't say this in a recorded video uploaded to the internet, but I never liked following the rules very much. Actually, that's not completely true. The more honest answer is, I have trouble following blindly. I need to understand the rationale behind the rule. If my compliance will keep me and others safer, then I'm more than willing to be obedient. I very much recognize that just because I don't see another car coming, I shouldn't run that stop sign. Not because I might get a ticket, but because if everyone started ignoring them, mistakes would be made, and the consequences could be tragic. I never want anyone hurt due to my action. And for those in our society that don't consider those consequences, hopefully that ticket and the threat of a suspended license will get you to fall in line. When it comes to investing, many of the rules, and I'll use the definition of rule very broadly, many of the rules are merely guidelines. They have become conventional wisdom or rules of thumb. Usually they're helpful shortcuts that can keep you from making less obvious financial mistakes. With a little financial sophistication, however, you quickly learn that many of the investing rules are merely guidelines that should be questioned and occasionally ignored. A quick digression. The phrase rule of thumb is thought to have come from taking an approximate measurement in the trades. If you don't have a ruler handy, you can always use your thumb. The space between the tip of your thumb and the first knuckle is about 1 inch. So a rule of thumb is a quick, imprecise measurement or simply a guideline. Some good rules of thumb. You should pay down high-interest debt. Start saving and investing early. Have a few months of emergency savings, particularly if you're a government employee. Bad joke. Other rules of thumb are less obvious and useless and even obnoxious. Buy low and sell high. That's good advice, assuming someone can tell you objectively when an asset is at a low or a high. I've been working on Wall Street for 30 years. If I could always buy low and sell high, I'd be on my yacht in the Mediterranean. Or this one that's being invoked a lot lately, buy the dip. This one only sort of works, and only because over the long term, the major stock market indices have always moved higher. 2 points of caution. I very specifically said over the long term and the broad market index. Stocks can always go a lot lower in the short term, but given enough time, the broad market index has always gone higher. If you bought the initial dip in tech stocks in 2000, it took more than 10 years for you to recover. I experienced that one firsthand. The second part, broad market index, individual companies don't always simply dip. There are plenty of stocks that dipped and then dipped more right down to zero. Washington Mutual, Lehman Brothers, WorldCom, Enron, Xerox, and Sears, and Kmart. If you bought the dip in the meme stock darling AMC Theaters, you're still waiting for the payoff. One of the investing rules of thumb we think a lot about is diversification. Just about everyone knows that an investment portfolio should be diversified. Everyone knows that a diversified portfolio reduces risk, except that diversification is the enemy of performance. Let me unpack that. You can be too diversified. If you own too many different securities, you might as well just own the entire index. There comes a point where your positions are so diluted that the impact of getting a stock right, buying low and selling high, there's no material impact on the performance of the overall portfolio. It just becomes noise, a lot of static that does nothing for you. Why pay someone to manage the assets? Just go out and buy a low-cost ETF of the S&P 500 or the entire technology sector, for example. At that point, you don't really own individual stocks, you own the market. As portfolio managers, we analyze the likely future earnings and cash flows of companies that we invest in. We look at growing industries, artificial intelligence, weight loss drugs, or companies that are turning their business around. We generally limit portfolios to roughly 20 stocks that have varying prospects in different areas of the economy. By concentrating our focus on fewer winners, we have some diversification, and if we're right, it comes with better performance. Lastly, while there are rules of thumb for asset allocation, how much you should have in stocks or bonds or real estate or gold or even crypto, there is no magic formula that takes you and your entire financial situation into account. Furthermore, the rules don't consider what's currently happening in the actual economy. If interest rates are likely to rise, fixed income exposure should be reduced. If inflation is high and government debt is growing and interest rates are falling, the dollar will likely be weak and the allocation to commodities such as gold should be increased. The various scenarios get very complicated very quickly. One more thing to think about. Most asset classes these days are highly correlated. You're probably less diversified than you think. Here's a chart showing the S&P 500 price in Bitcoin since 2017. Don't think you're hedging your stock portfolio by buying into crypto. The two assets move very much in tandem. Financial rules of thumb can be helpful at a basic level, but there's often good reason to bend the rules if you know what you're doing. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.